I understood it wholeheartedly.
Right.
But then I talked to my attorney, who originally was kind of like, Jim, I never heard of that. I don't really understand it. I said, well, we'll schedule a call with Todd and he can talk you through it. And Todd's a CPA and a tax attorney, so he understands all the law. That's why he developed it. And then called the accountant, and she's like, well, I just think you should pay the capital gains tax.
How did that feel once you said that?
I felt like I needed a new attorney or accountant.
Hey, welcome everybody. Brett Swartz here with Dan Palmer, Capital Gains Tax Solutions. We're driving right into our client success story kind of review. It's where Dan and I break down some live, some deals that have closed. We do it live as a kind of a way to reflect, so that you, either the advisor who's wanting to help your clients and or you who's the owner wanting to sell, has a chance to get the play-by-play. Our goal is to help you overcome any challenges that are holding you back from using our services, and so some transformation from our clients. And so I'm excited to bring in Jim Orr via the video on YouTube, which you can find on our Build It to Billions podcast YouTube channel and Capital Gains Tax Solutions podcast. So here we go. Here's Jim. Talk about that legal part. Even though you talked to me, you talked to Todd, the tax attorney, you're feeling good.
Oh, I understood it wholeheartedly.
Right.
But then I talked to my attorney, who originally was kind of like, Jim, I never heard of that. I don't really understand it. I said, well, we'll schedule a call with Todd and he can talk you through it.
Yeah.
Todd's a CPA and a tax attorney, so he understands all the law. That's why he developed it.
Right.
And then called the accountant, and she's like, well, I just think you should pay the capital gains tax.
How did that feel once you said that?
It felt like I needed a new attorney or accountant. But, you know, they were both willing to get on. They got on the call with Todd. He talked them through it. They both asked some questions. You were on. And in the end, they both told me, no, sounds good.
We're going to try to splice this thing together. Dan, so this is what we found happens with 90% of the CPAs. If they actually sat down and talk and go through it, they end up using it. So, I mean, what do you take from what Jim just said there about his accountant and the first hesitation with the legality of our services?
Yeah, it's funny. The clients are shocked when that happens, but then when they tell us, we just kind of laugh because it's so common. You know, a CPA or whatever that doesn't know about this structure and really, quite frankly, doesn't really want to know. They just want to pay the tax. That's what Jim said. He's like, yeah, they just said, I think you should just pay the tax. And he said, I think I need a new CPA. You know, when you have a CPA that's not going to investigate the legal opportunities out there for tax strategies that can help you enter into a deferral state, you're going to miss out. And it's going to cost you. So luckily, Jim's a pretty strong, he's got a military background. He's a pretty strong guy with what he wants. So he said, hey, you need to meet up with the tax attorneys for this structure. And he kind of drove that. And I would tell our clients, you need to drive that. You need to get your CPA or your tax attorney or whatever with the tax attorneys on our side, discuss the structure. Because once they hear it, they go, oh, that makes total sense. It's not tax evasion. It's not tax avoidance. It truly is tax deferral. This is the government's idea. And they get on board. It ends up not being a problem. But, I think the CPAs don't have any reason to say, hey, go for this thing that I've never heard about. They probably feel like it's putting them at risk. But once they have the conversation and they hear about the structure, they're okay.
Yep, 100%. And I think the couple things, most CPAs just want to know how to report it properly. Their biggest concern is audits and or not reporting things properly. So once the tax attorney walks them through the track record of thousands of transactions, close to 30 years, all the audits, audits, all no change, no findings, and how to report it, they're like, oh, okay, actually it's pretty simple. In fact, for the one version that we use that's 98% of the time, it's just an installment sale. You actually report it in the exact same form, 6252. You're reporting it the same way you would if they just did a regular seller carryback. And I think that's kind of an aha moment for a lot of CPAs, because they're like, oh, so it's not an audit trigger. In fact, the deferred sales trust has never triggered an audit for any ones that we've done ever in the history of the trust. The asset or the client the asset that was sold, or the client that was a high net worth client, had an audit, and they happened to find the trust and find the transaction and then audited the deferred sales trust, but it's never been like triggered by it. So we're not a reportable transaction. We're not we've never been on a dirty dozen. We've never been on an IRS watch list. And so I think the action step for everyone who's listening is be proactive like Jim. A, do the planning, but B, don't take no for an answer. Or that, I think sometimes in these emotional, high charged events for selling, especially businesses, clients sometimes want to take I don't want to say the easy way out, but let their fears, you kind of get what you're looking for, right, in life. So if you're going to look for things that are, challenging, or you're skeptical, or you're cautious, not that you shouldn't have, wisdom and discernment when you're going through this, but you're almost like getting what you're looking for. I'm thinking of the ones that we had lost. The fact pattern was they were really coming into it with a pretty closed mind. And then 2, they weren't willing to let their CPAs come on to the calls, or they weren't going to push them to come on, or pay for them to do the due diligence. And they kind of played this role of like, okay, I know the answers, and I'm the guy who can figure it out, the gal who can figure it out, and I'll just talk to the professionals out here, but I won't bring the people into the room, right? And I'll make this decision based upon talking to the CPA, what they have to say, and then the tax attorney, and talking to Brett and Dan about it, and talking to the real estate person or the M&A advisor. And it's kind of this fragmented, not in the right sequence, not in the right rhythm of delivering the information. And they become the roadblock for themselves. And it's almost like they feed into what they, their worst fears or their thoughts of what it could be, instead of saying, okay, let's break this down. Let's bring the professionals into the room. Let's definitely listen and ask questions, but let's see if this can fit. And the reality is I feel like 98% of the time that someone takes that approach, they hire the who, not be the how, and they let the professionals work through the process of what it looks like. It becomes pretty simple. The ones that aren't are the ones where they're not doing it. Any feedback for those who are listening on that, Dan?
Yeah, I think with a highly appreciated asset sale, when you're going to have a large capital gains tax hit, as far as the client goes, deferral is ideal. They're the ones that are going to benefit from it. From a CPA's perspective, if it's something they don't know, it's all risk and no upside. It's not their money. They want to make sure it's all done legally. They're normally more strict people. So not to vilify CPAs at all. We love CPAs. They're the best. We're talking about a very specific instance where they don't know about the deferred sales trust, and their automatic, feeling is just to say, just pay the tax and don't do it. When they get in the room and they learn about it, and this is pretty much my favorite part of the story, Brett, these CPAs that were resistant, that were maybe putting up a roadblock because they didn't know about it, but we get them into the room with our tax attorneys, and they hear about the structure and they understand how it works, they become referral sources for us down the road.
Yep.
And I think that tells the whole story. So getting them into the room, getting them to have that conversation makes all the difference in the world.
Yeah, let's hear Jim say this, because the video might have been cut off when we first started. Let's hear his story real fast on this. This is Jim Orr, former colonel in the Army, amazing guy out of Pennsylvania, sold a self-storage business in real estate property.
They were both willing to get on. They got on the call with Todd. He talked them through it. They both asked some questions. You were on, and in the end, they both told me, no, sounds good.
Right? Yeah, so you set up the call, you encourage them to get on the call, you get them on the call, and
then I paid him for being on the call.
Yeah, you paid him to be on the call, right? Yeah. And then they give the hey, sounds good, green light, no red lights anymore, and you move forward. We found that is the consistent theme, right? Because if the CPA had already known about it, they would already presented it to you, or had they had another solution, you wouldn't be there looking for something else.
Right.
But at the same time, if you don't encourage them to get on that call, you can't. It's unreasonable to expect that they're going to be positive about something they don't know about or haven't done yet. And so that's been my experience, right?
Perfect. And I want to go to the next thing, which is fees. In fact, and you can find this by going to Capital Gains Tax Solutions YouTube channel, and then you search on the playlist, and you search fourth down from Military to Millions with Jim Orr, and he shares his entire story, and you can watch all of it, all of the interview. I'm going to fast forward to the part about fees, because one of the bigger challenges, Dan, that people have is fees, right? And so tee that up for everyone before I bring up his Jim's video. What's the biggest objection? Like, frame it for people, and then we'll play the video and we'll talk through it.
Yeah, I mean, fees are fees. If you don't get any benefit from the strategy, it can feel expensive. But when you see the result for you, how it grows your wealth, you realize that those fees are an investment. And so primarily the first return on investment is 25 to 40% of the proceeds you're going to hold on to. Still the government's money, but it's going to be in deferral state, and it's going to be invested, compounding and growing in your favor. So that's the first thing. The second thing is the interest income that you don't receive from the trust also continues to grow. Interest income, tax deferred. And so you can kind of create an engine for growth, and it's very, very powerful. So when we get into discussions about fees, and we're very transparent about it, because our relationships with our clients are lifelong. And so, we're not trying to, hard sell or jam someone into something. We try to lay out everything, because in our heart, we know 100% it is an incredible benefit and investment for our clients. So it's not really an expense. It's more of an investment.
I couldn't agree more. Let me share Jim's thoughts on this, and then we'll continue to break down the value here.
Man, how do I make this thing an investment and not an expense? So what has been the way that you found to make it an investment, not an expense, when perhaps in the beginning you're like, whoa, is this expensive? As sometimes people have in their mind.
Well, my evaluation, and this because I'm a spreadsheet kind of guy, was I looked at, if I do this with the DST, and the DST saves, and I'm just going to throw a number out because it's easy to calculate, $1 million in taxes, because you don't have to pay that until you request your promissory note money back. You have $1 million working for you. Well, if you're getting $1 million and that $1 million is returning 10%, and I'm getting 9%, you're making your fees, and I'm making a little bit of money off of that. I might not make all of it, but if you're getting your fees for everything that we have, out of that, I haven't lost anything.
Yep. Yeah.
And there's some value to paying somebody to do something to help you be further ahead of the game.
100%.
Okay, so let's break this down so everyone is really clear on this, because this can be a little bit confusing unless you kind of hear and understand it. So let's just say $1 million is net goes into the trust after all the closing costs for your sale, and you're working with a financial advisor, and we're putting it all into, like, let's say a Schwab or a Morgan Stanley or Merrill Lynch, or different places that they're managing the capital, and they're 100% managing all of that capital. Generally, it's about 1.5% to 2%, including the financial advisor. Okay, so that's both parties there. The other scenario would be it goes into 100% real estate deals, either on your own or partnering with the trust, or going into passive real estate deals. That's also 1.5% to 2%. In that scenario, let's imagine the financial advisor is not managing any funds, but it's still about 1.5% to 2%. We get paid a little bit more if we're going outside of like, let's say stocks, bonds, mutual funds with the securities advisor. And so that's the general path for the fees, plus like an accounting fee and then a tax return fee. But that's the general fee. And so what we're saying, and what Jim was saying, is, hey, if I would have paid $1 million up front on the sale of his business real estate, instead I can have an interest-free loan from the government, meaning I'm not getting charged on that $1 million. I can let it earn, and if I earn an extra 9% net of fees, 8% net of fees, gosh, like, that's really great. I only pay tax on what I receive in that given year, and I let this money keep working for me. And so it's tax deferral. And yes, if he ever dips into the principal, would he pay that $1 million or portions of that $1 million? But to the extent that he keeps kicking the can, meaning the note keeps renewing and his kids keep renewing, it's an ongoing money-making machine. Dan, any thoughts on that, or any clarification on fees? And then we'll dive into a couple other little quick strategies here too.
Yeah, I thought Jim did a great job. If he's able to hold on to the $1 million that he owes in capital gains tax, and it earns 10% net of fees, that's $100,000. Or even not net of fees is what he was saying. He's saying, if I earn an extra 100 that I never would have had, and I pay 20,000 to the trustee and the investment advisor, I'm still walking away with 80,000 that I wouldn't have had otherwise, recurring. Every year I'm getting 80,000 that I wouldn't have had otherwise. I think that's powerful. And so I think that kind of lays out how it's an investment, not an expense. Gives people an idea. Yes, there are fees. Of course there are fees. It's an incredible strategy. There's a lot of work going into it. But the benefit on your side is multiples of any fees.
Absolutely. And the other thing I would say is part of what our unique proposition and to help align making the DST an investment, not an expense, is we actually wait about 60 days post closing, and our goal is to cash flow the fees and cash flow the payments as best we can. It's our goal. Investments are investments. We can't guarantee anything, but at least we wait a little bit to get time on your side. And so think of it like a plane. You landed $10 million into the trust that you would have paid, let's say $3 million in tax. And instead of taking $150,000 of fees right away, we let that $10 million get off on get some altitude, start flying for 60 days, and ideally we're able to cash flow the fees. Okay, and so it all depends on the investment and the risk tolerance, and what you approve of the trust to invest into, and all of these things. But that's another way that we try to align with you, the seller, and you, the advisor, because advisors are coming to clients with strategies, and they want to know that they have competitive fees, and so we're very strategic about that, and that's something that we want to encourage you to check out. Dan, I'm not sure if you have any more time or if you're up against the wire. If you're up against the wire, we got to jump. But otherwise,
the wire, yeah.
Okay, so we're going to jump today. Appreciate everyone listening and watching out there. Of course, if you have a live deal, you can go to capitalgainstaxsolutions.com. You can schedule a time with one of our team members, and we can dive in to see if your strategy, if your sale qualifies. Remember, it works for business, Bitcoin, stock, primary home sales, commercial real estate. We can save a failed 1031 if you get to us before you sell your property, and we need to get this set up prior to the close. So go to capitalgainstaxsolutions.com to schedule a no-cost consultation. As long as you have $1 million net proceeds, $1 million gain is the minimum to qualify for the call. And we have the book, Building a Capital Gains Tax Exit Plan, that you can find on Amazon. I'm Brett Swartz. He's Dan Palmer, Capital Gains Tax Solutions. We appreciate everybody, and we'll talk to you again soon. Bye now.